The S&P 500 just had the best week in 2024. However, when we look at the whole year performance, there are some stocks that have absolutely been hammered, and that is our focus in today's episode. We're looking at 5 stocks that are trading at their 52-week lows and have been hammered around 50% year to date. Now, the first one we're looking at is Estée Lauder. Going to be very brief analysis. We're going to look at the historical performance. We're going to look at their earnings and a quick valuation. For EL, well, we notice it's down around 56% year to date. If you've been a long-term shareholder over the last 10 years, you would be down 10%. So in fact, you would have less than the original amount in 2014. Now, we also note from the peak of their all-time highs in December 2021 at $370, Estée Lauder has just been coming down very severely, as we can see right now, trading at its 52-week low. Now, we get a double hold from Seeking Alpha and Wall Street with a strong sell signal from Quant, and we can also see their dividend yield right now sits around 2.2%, and their forward PE does look very high at a 37 level when the S&P 500 itself sits at 25. Now, in terms of their earnings, over the next 3 quarters, they are expecting double-digit decrease to the EPS year on year. However, when we look at the previous 4, they did have a 100% track record, beating management targets, so that is a good sign in terms of their historical forecasting accuracy. And the next full year, June 2026, they expect large growth to the EPS, ultimately lowering the forward PE 22.92. Now, in terms of their dividend safety, we can in fact see they had a cut just over the last few weeks, around 47%. So we do note their dividend remains to be unsafe with a score of 40. And if you want more details about the metrics, we did do a deep dive not too long ago on this channel. As we said, very brief analysis, so we are going to jump straight into the valuation. Each one of these companies, we're going to say buy, hold, or sell. Now, typically on this channel, we get to the intrinsic value of each company. We talk about the inputs, the outputs of every single model. Today, though, we are going to get straight into it. Now, we've got $62 average of Graham's valuation, DCF, and the multiples model, and we see the current price around 64. So we believe Estée Lauder right now is trading around its fair value. Wall Street, on the other hand, their price target sits at $84. They see upside of 31%. Now, the reason we have this margin of safety on this channel, we always like to use a minimum 10% before executing, and we use that for companies that have essentially our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. As we said though, this company has no margin of safety based on this model, trading around its fair value. Those who want to see 10% at buy at $56, 15% around $53, 20% around $50, and 25% around $46. So no margin of safety, so for us this would definitely not be one that we would consider in the portfolio, although we do know Wall Street are bullish with their signal of 31% upside over the next year. And as we go along these stocks today, give us your opinion as well, whether you are buying, holding, or selling. Now, also to let you know, we have released our latest free weekly article where we run through 2 stocks that we are buying this month. Now, we release one every single Monday morning for free directly to your inbox, where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. So click below, sign up, and you can read straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year as well. And on top of that, you can grab a copy of 22 undervalued dividend stocks that Wall Street themselves believe have the most upside out of the whole S&P 500 and this moment in time. So click below, sign up, and you can read straight away. We then move on to WBA Walgreens Boots Alliance, down 66% year to date. And if you've been someone who's holding this over the last 10 years, this is probably one of the worst returns we have seen on this channel, negative 86%. And to see your all-time high for this company, you need to go around 2015, where it was trading at just under $100. In fact, $95 was the value in July 2015. We can see the value right now, $9. So a massive drop, unfortunately, for shareholders. Now, it is trading right there towards its 52-week low, and we get a triple hold rating right across the board. Now, their yield does look very high at 11%, and we'll come onto the dividend safety shortly, but they had a dividend cut not too long ago in 2024, and we can see the forward P right now sitting at 5.7. In terms of their earnings, well, no surprises. Over the next 4 quarters, they're expecting double-digit decreases to the EPS year on year. Although 3 of the last 4 quarters, they have beaten 75% track record. Nonetheless, they aren't expecting much movement to the earnings per share from August 25 to August 26. Therefore, the forward P is looking to be fairly similar at 5.67. Now, dividend safety, actually a 20 score, which means very unsafe, so definitely on red alert that there may be another dividend cut. As we already mentioned, negative 48% in January this year. So what about WBA in terms of the valuation? Well, our intrinsic value at $11 does give a margin of safety, unlike the first stock that we just ran through. At 10%, a buy at $9.64, at 15%, pretty much bang on the current price, but similar to Estee Lauder, we don't believe this is a buy in the market. What we can see though, similar to Estee Lauder, where we said we weren't looking at this for one in the portfolio, Wall Street do believe there is a lot of upside, 50%, with their price target around $13.67, and do give us your thoughts below. We then move into the semiconductor industry with STM, in fact year to date around negative 48%. If you've been a long-term shareholder, very interesting, even after pretty much dropping in half over the last 10 years, they've outperformed the S&P up to 178%, trading at their 52-week lows with a double buy signal from Seeking Alpha and Wall Street. Do note 4.5 would turn this into a strong buy, so Wall Street do believe this one as serious consideration. Quant, on the other hand, giving this a sell rating. They pay a yield 1.24% and a forward PE sitting just below 16. When we take a look at their earnings, well, the next 3 quarters they are expecting double-digit decrease to the earnings per share, and out of the last 4 quarters they did beat in the more recent one. However, they have one miss, giving it a 75% track record, and we must point out that over the next full year, earnings per share is estimated to decrease 1.67 to 1.55, therefore increasing the forward P to 17.15. Now, we don't have a dividend safety score just yet, but what we can see is over the last full year, they did increase that dividend by around 50%. And when we get to our valuation at $41, there will be some nice margin of safety. 10% a buy at $37, at 20% a buy at $33, at 30% around $29, and when we look at 35%, we can see it isn't far off. So STM around 30 to 35%. With Wall Street very bullish, $42, they see 56% upside, so definitely one to consider. 30% MOS, 56% upside. However, for this, we wouldn't give it a sell rating like the previous 2. We wouldn't give it a buy rating, we'd give it a hold. Reason for this, we believe in the semiconductor space, there are a lot of better high quality companies with as much upside as well. For example, we did cover ASML not too long ago, so this for us is getting a hold rating. However, as always, do give us your thoughts below if you do want a deeper dive onto any of these companies. Now we move on to Intel, which was actually a dividend stock at the beginning of 2024. However, they did cut that not too long ago, down 48% year to date. Over the last 10 years, if you have been a shareholder, unfortunately down around 23%. Trading at the lower end of the 52-week range with a triple hold rating right across the board, and as we said, they did cut that dividend. So in terms of their earnings expectations, well, the next 2 quarters they're expecting decrease year on year, and in fact the previous 2 they did miss, 50% track record. The positive to take is from the negative earnings per share estimate of 2024. That is in turn expected to move to a positive 0.98, bringing that forward P to around 26.73. So what about the valuation? Well, our intrinsic value at $28.20 will give some MOS at 10%, not far off, so not quite there yet, sitting somewhere today's episode of Intel 5 to 10%. Now, Wall Street themselves believe this company is marginally overvalued as they see this at $25 over the next 12 months, giving this 4% downside. Now, our thoughts are very similar to what we just concluded when we looked at STM. In terms of this space, there are a lot of better high quality companies, but maybe this is one that you do believe over the longer term will turn around and you will be rewarded as a shareholder. Again, do let us know below. We then move on to Kering, which is down around 46% year to date over the last 10 years, up although very marginally around 33%, and we can see all-time highs around 3 years ago at $941. Right now though, trading right at its 52-week low with a buy rating from Seeking Alpha. They also pay a very high yield, and this is due to the fact the share price has come down significantly just in 2024, and the P sits around 14.3. Now, in terms of our valuation, well, $292, it is higher than Wall Street. They see 262 with upside of 10%. But when we do look at the MOS at 10%, a buy at 263, at 20%, not quite there yet, so sitting between 15 to 20%, and they have been struggling, especially in the more recent period. Again, if any of these interest you, we can look to do a deeper dive. So Kering isn't one that we would consider to buy, but if you want to see 15% MOS, 10% upside, give us your thoughts, and if you did enjoy today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And you can always grab a copy of this model by clicking on the pinned comment below, where you can sign up to the free weekly newsletter and come and join us in the Patreon where we talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.